Have you ever wished you could just go back and change something? Well, believe it or not, in the world of accounting, companies kind of do it all the time. Today, we're going to pull back the curtain on how they can legally rewrite their own financial history, and more importantly, why you should care.
You'd think, right? You'd think that once a company puts out its annual report, that's it. The numbers are locked in. But what if they're not? What if there are totally legitimate, sometimes even mandatory reasons for them to go back and change things? That's what we're digging into today.
Okay, let's be clear. This isn't some shady, under-the-table stuff. It's all part of a regulated process. But thinking about it as financial time travel is the perfect way to understand how this all works, when companies adjust the past versus when they just change course for the future. So, when an accountant has to make a change, they basically come to a fork in the road. Path number one is to look forward. This is called prospective application. You just accept the past for what it is, and any changes only apply from this day forward. But path number two, that's where you travel back. That's retrospective application, and it means you actually have to go back and restate previous financial reports.
All right, let's start with the easier route, looking forward. This is the one you see most often, and it's all about reacting to new information without having to rewrite history.
This forward-looking path is for something called a change in accounting estimate, and it's pretty much exactly what it sounds like. You made your best guess in the past based on what you knew, but now new information has come to light. So you don't pretend the past was different, you just adjust your sales and move forward from here.
And these kinds of changes, they happen all the time. A company might guess a factory machine will last 10 years, but it turns out to be a real workhorse. Or maybe they set aside $1 million for a lawsuit but end up settling for way less. These aren't mistakes, right? It's just business, and it all requires a forward-looking fix.
This example with the truck makes it super clear. So, check it out. Carl & Company buys this truck, and the plan is to depreciate it over 10 years. Easy enough. But then reality hits. After just 2 years, they figure out this truck is only going to last 5 years total. So what do? They don't go back and edit the past. Nope. They take the truck's remaining value, that's $72,000, and they spread it over the new remaining timeline, which is now just 3 years. The result? That depreciation expense suddenly jumps up to $24,000 a year for the next 3 years.
And this is the absolute key to the whole looking forward idea. History is history. The books, for year 1 and year 2, they stay exactly as they were. The change only affects right now and everything that comes after.
Okay, now for the really cool part. Let's fire up that time machine and look at the path where companies are actually forced to go back and rewrite their own history books.
So it really boils down to 3 big reasons a company would do this. First, a change in accounting principle. That's like deciding to switch from one valid accounting method to another. Second, a change in the entity itself. Maybe the company bought or sold a major division. And third, the one that's easiest to understand, they just made a mistake in a previous year and now they have to fix it.
And that's the whole idea behind retrospective application. The goal is to make the financial statements look as if the new method, or the correction, had been used all along. It's all about creating a consistent story over time.
And this slide right here tells you why that's so important. I mean, think about it. If a company changes a major accounting rule, you can't really compare this year to last year anymore. It's like comparing apples to oranges. By going back and restating the past, they're basically turning last year's oranges into apples, so you can make a real, honest-to-goodness comparison.
And to see just how big of a deal this can be, just look at that number. That is a real $2.7 million after-tax hit to a company's books. They had made a huge depreciation error in past years. When they found it, they had to go back, correct the past, and it directly reduced their retained earnings, which is just a fancy term for all the profits the company has ever accumulated.
But check this out. It gets even more interesting. In that same year, Jordan also decided to change how it values its inventory. They switched from one method, LIFO, to another, FIFO. Now, this was a change in principle, and you can see it had the exact opposite effect. It increased their accumulated profits by $3 million. So in the same year, they fix an error that made them look worse, and they make a principle change that made them look better. As an investor, you might see that and think, okay, they're cleaning house and getting everything in order at once.
So, you're probably thinking, wow, this time travel stuff sounds like a massive headache. And you'd be right, it is. So, are there ever times when the rules kind of bend a little? Well, yeah, there are. There are a couple of key situations where a company gets a pass on rewriting history. The first is if it's impracticable, which is just a fancy way of saying it's basically impossible to figure out what the effect on past years would have been. The other big one is when you change your depreciation method. Even though that's technically a change in principle, the rules say, you know what, just treat it like an estimate and only apply it going forward.
And it all comes down to one word: practicality. The accounting rule makers get it. You can't always perfectly rebuild the past. If the data just isn't there, or if it would cost a fortune to dig it up, the rules let you just move on.
So, what's the big takeaway here? Why should you really care about the difference between looking forward and looking back? Well, it all comes down to the different stories these changes are telling you about a company.
And this brings up a really smart question that you might be thinking right now. If a company goes and rewrites its past, doesn't that mean that the final number from last year's report won't match the starting number on this year's report? It just feels wrong, doesn't it?
And the answer is actually refreshingly blunt. The source material puts it perfectly. It's normal that this makes your opening balance different from last year's closing balance. That's exactly the point. That little mismatch you see, that is the adjustment. It's the proof that a change was made to bring the past in line with the present.
In the end, these two paths tell you completely different things. A prospective change, looking forward, it's like a company adapting to new conditions. It's normal, it's forward-looking. But a retrospective change, that's a signal of a fundamental shift. The company's either admitting a past mistake or changing its very foundation to make its reports more accurate and comparable. So, to wrap it all up, those financial reports are not set in stone. Prospective changes are all about the future based on new estimates. Retrospective changes are about rewriting the past, either to fix a mistake or just to make things more consistent. Knowing the difference between them is how you really start to read between the lines.
So, I'll leave you with this thought. The next time you see in the news that a company has restated its earnings, don't just brush it off as some boring accounting thing. Ask yourself, what story are these new numbers really telling me about where this company has been and, more importantly, where it's going next?